So look, there's nothing that's really changed since our mid-year outlook. I think we still have this list of things that we think could present short-term tactical risks to the market, but we view those as things that might generate something like a 5 to 10% drawdown at worst. Those are things like the midterm elections later this year. I know, there's a lot of stories starting to percolate there, and interest from clients starting to percolate as well. At some point, we'll deal with 2027 earnings growth expectations. We're not there yet. We're still sort of sorting through 2026, but that's something to keep on your radar as well. And it feels like interest rate fears have eased back a little bit, but that's something also to keep on our radar. I know there's just a whole range of outcomes predicted around the street right now. Some people looking for cuts, some people looking for hikes, but we do sort of keep that hike risk on the radar. But Tom, we really, with the price target, we try to be longer term. We've recast it this year from a December 31st number to a 12-month forward number. We update it once a month. We did a little bit, later last month than we probably should have, but we had a number of events to get through, and so we upped our target a little bit to 81.50. Healthy, not heroic. We still think that the earnings strength, the earnings tailwind, is offsetting pressures on the PE from the trickier rates and inflation environment. So no real change.
What is the AI theme in your work these days? I guess we all started our own AI investing by just buying the chips, which is still a way to go, no doubt. But is there other ways to play AI that you and your team are thinking about?
So, I think it started out as sort of a Mag 7 type story, right? And then we saw in the earnings data that the AI trade was really sort of broadening out this year. And then the semis were front and center, and we're kind of at peak revisions there on earnings. You've had expensive valuations, so people are looking around for other opportunities. And frankly, Paul, that's been a consistent conversation for the last 2 months, including last week.
Okay.
And I think that, we've got to sort of look at the earnings growth trajectory over the course of the next year. I think the broadening we've been seeing recently could go farther, but at the same time, I still expect that earnings story to favor the AI-centric names. So we think the market will come back to that after the valuation correction has been solved. But, I'll give you one example. Our energy conference at RBC in early June, and we have a rock star lineup of companies.
Excuse me.
They all talked about AI.
You mean the Halima Croft moment?
Yeah, well, Halima did our panel that I only went to the first day, but on the first day of the conference, Halima did a fantastic lunch panel.
People let you speak to her?
We're very good friends. We talk all the time. But, it was funny, outside of Halima's presentation, which was all about sort of the Iran war and oil price dynamics, I was listening to a bunch of energy companies talking about how they're helping power data centers. Right. So I guess my point, going back to Paul's original question, is increasingly investors are going to be looking for how AI affects kind of the end users, and we're still in the early stages of that right now.
Ed Yardeni out reaffirming, folks. We're with Lori Calvasina, RBC Capital Markets, reaffirming on Standard & Poor's 500. So I did a log regression from the Yardeni and Campora low of 2022. And basically, it's an exercise in extrapolation. People are just taking the trend we've been on and moving it out. I get to year 8100 near the end of the year, plus or minus, a couple weeks and all that. Is it just simply an exercise in extrapolation?
Not for us. We have 5 different models, and 8150, it's a 12-month target, but it's basically the median and average, an approximation of those of the 5 different models. And at the low end is our GDP test, which comes in at, I think, 77, which is, only looking for about a 5.7% return based on the idea of a 1 to 2% GDP environment. We could be in the process of moving those forecasts up, so we'll have to see how the consensus trends. But on the high end, some of our models are signaling more than 8,300. 2 of them, our sentiment model and our valuation and earnings work, are right around that 8150 mark. Again, just kind of going back to the valuation and earnings data, we take the current consensus, haircut it by 5%, take a PE that's based on a projection of inflation that's still running at 3%, 1 hike from the Fed, and 10-year yields, with some pressure on them as well. And, what we see in our modeling is that the earnings tailwinds can still offset, those headwinds from the PE compression in the year ahead.
I know historically you've looked at Duke's CFO survey. What's that telling you now?
It's a fun survey.
What?
The Duke CFO survey.
And it comes out, shortly around reporting season, every quarter. And so I think it gives a really good reading that those folks do just a fantastic job of asking hot topic questions in addition to kind of the basic outlook question. And I would say the basic outlook question was the most interesting to me this time around. And what you've seen consistently in the post-COVID world is there's a gap between companies' optimism about their own company versus the economy. So we saw optimism on their own companies ticked up just a little bit, optimism on the economy ticked down, but that gap remained very, very wide. And I think it speaks to the resiliency of corporate America and their faith in their ability to manage through. So we expect to hear more of that in this upcoming reporting season.
Not a trick question, Paul, to you as well. What is more valuable, the CFO survey or the CEO survey?
Well, we look at a number of different surveys. So we look at the Business Roundtable as well. Conference Board has a good one. I mean, maybe I'm just a data nerd, right? So I'm partial to the people who are crunching all the numbers and deep in the weeds. But the CFO one sort of speaks to me a little bit more.
Yeah, those are the ones allocating the capital, and they decide, what gets funded and what doesn't.
And when you get into trouble, all of a sudden, that's where the phone calls come into.
Yep.
Right.
Outside of AI, what's screening well for you guys, whether it's a industry or a factor? What are you guys looking at?
So, I think the financial sector still looks interesting, and this has come up a bit in conversations recently. So valuations still look very reasonable. They're moving up a little bit in absolute terms, but still look cheap in relative terms. Earnings revisions have been good. If you look at, one of the ways the sector trades, it tends to do very well when consumer sentiment on the Michigan survey is rebounding. And we have seen, across the consumer surveys, I know the headlines are always, negative and how low they are, but if you kind of zoom out, it looks to me like those indices are trying to stabilize. So we've been increasingly talking to clients about if we have sort of seen the lows on consumer confidence or sentiment and get a turnaround. This looks like a sector that should benefit from that. And it's also, one of the more reasonably valued areas of the rotation trade.